Hey everybody, it's Jack and welcome back to another video. Today's video I'm really excited about. It is going to be another dividend stock video. In today's video, I'll be going over 3 of the top Canadian dividend stocks that I think are great buys for the month of May. The 3 dividend stocks I'm going to be covering in today's video are extremely different. They are all in completely different sectors and all have quite different dividend yields. Some are on the lower end, some are in the middle, and one of them is on the high end. So definitely think there's a dividend stock in this video for every single type of investor out there. So I really hope you get some good information out of this, and let's dive right into the video. The first dividend stock to buy for the month of May is truly a Canadian dividend growth king. It has been raising its dividend for the past decade at an annual average rate of 15%, which is actually crazy. And to add to this, it has raised its dividend for the past 25 years straight. The company is one of Canada's 2 major railway companies. Because there's only these 2 major players in the industry, there is such a high barrier to entry for other competitors that I really don't think this stock or company is going anywhere in the long term. Also, this company has just experienced an over 10% drop in its share price over the past few weeks. Because of this drop, I think it's currently trading at a very reasonable price and is why it is currently one of the best stocks to buy for the month of May. The company in question is Canadian National Railway, ticker symbol CNR in the Canadian stock market, and if you're in the US, the ticker symbol is CNI. Canadian National Railway currently trades at $133.70, and it currently has a market cap of almost $100 billion. So this is a huge company that we're dealing with and talking about today. And it has a solid PE ratio sitting at just over 27, while its dividend yield is currently sitting at 1.83%. So as mentioned, it is on the smaller side when it comes to dividend yield, but what it lacks in the current dividend yield, it definitely more than makes up with for the dividend growth. CNR also has a dividend payout ratio of 47%. So what this means is that CNR pays out 47% of its earnings to the shareholders through the dividend. So this is a very sustainable rate. Being under that 50%, the company is really going to be able to focus on the dividend payouts, keeping them consistent, as well as focusing on growing the business as they have been doing over the past, which leads us perfectly into the stock chart. If we look at the stock chart over the past month, we can see that 10% drop that I was talking about earlier. At around end of April, the stock dropped from being close to $150 down quickly to around $130. It has since slowly started to rise and is now at that almost $134 range. The reason for the significant drop was because CNR put in a massive bid for a US railway company called Kansas City Southern. They put in a bid for the company to buy out at $33 billion. This was well over the bid of their rivals, CP Rail. However, CP Rail is currently objecting to CNR's bid, so it's not 100% sure whether or not CNR will actually win the bid. And I think if they lose the bid, this will actually be a good thing. I think that $33 billion is quite a steep price to pay for Kansas City Southern. And I think if they actually lose the bid, we can quickly see the share price rebound that 10% that it dropped. While on the flip side, I think if Canadian National Railway actually wins the bid and has to pay the $33 billion to acquire Kansas City Southern, I think it might hurt them short term, but I think in the long term, this is just going to help them grow their business and expand it through the US and really start to conquer North America as a whole a little bit more. So I think in the long run, it's a good thing. And if we look at the longer period chart, we can see at the 1-year chart that CNR has done quite well since the pandemic last year, going from around $100 to now up 33% to that $133. And if we look at the 5-year chart, you can really see that CNR has been seeing consistent and steady growth year after year. Over the past 5 years, it has gone from $75 a share to up to that top of the peak where it was at $148. So almost a 100% gain over that 5-year time period, which is extremely great growth while you're still getting that 2% dividend yield as a nice cherry on top to just boost your returns even more. And if we look at the max chart, this is where it really starts to stand out. The amazing growth year after year that CNR is able to accomplish. You can see that how consistent and reliable they are. It is truly a rock solid company that is a Canadian dividend growth king, which we will now get into. So the main reason I think CNR is a great buy is truly the dividend growth rate, the rate at which every single year it's been increasing its dividend payout. You can see, I know it's a little bit blurry in the image, but a decade ago, the dividend payout for CNR was 54 cents per share. And over the past 10 years, it has gone up by a multiple of 5x and is now sitting at just under $2.50. This is a compound annual growth rate at 15%, which is a truly amazing number. So by buying Canadian National Railway and simply holding it for a few years, you're going to start to see a 3, 4, 5, 6% dividend from your shares by just holding them, as that dividend payout continues to grow every single year at the rate at which it's been doing. It's truly a great stock and great reason to hold this one long term. Another great reason I like CNR is because of the diversification in the commodities that they transport across North America. They are not strongly tied to one revenue source. They are spread out across many companies and many different resource types that gives them that long-lasting revenue, which is just another plus in my book. Not to mention, there's currently 17 analyst predictions on Canadian National Railway, 7 being buys and 10 being holds for an overall moderate buy. However, I really think there is a lot of upside in the dividend growth of this stock. So the current upside for the average analyst price rating is around 10% in share price, with the high end being at over 20% at $164.99. So moving on to a second great dividend stock to buy for the month of May. This stock has a much higher dividend yield than the first stock we saw, which was Canadian National Railway. This stock has a dividend around 6%, which is awesome. It also has been raising its dividend for the past 21 years straight, so another dividend growth king. The company in question is in the energy sector, specifically the natural gas space, and this is one that has long-term contracts, which makes its dividend super safe if anything were to happen to the stock market in the short term. This is a super reliable stock with a rock-solid dividend, so it's a no-brainer and definitely one of the top stocks to buy for the month of May. The company in question, I won't make you wait any longer. It is TC Energy Corp, ticker symbol TRP. TC Energy Corp currently trades at $61.05 per share, and it has a market cap of around $60 billion. So yet again, another well-established company that has been around for a long time. And what I really like about TC Energy Corp is how defensive of a stock it is. It currently has a PE ratio just under 13, which is really good for an energy company, which in my eyes makes this a great buy for the month of May, because as we see PE ratios on average being at all-time highs, this is a great defensive buy against if anything were to happen to the stock market over the next few months. And this stock has a really attractive dividend yield sitting at 5.72% currently. And the dividend payout for TC Energy Corp is currently sitting at around 70%. Which you might think is a little bit high, but like I said, TRP has long-term contracts that have lifespans of over a decade, which gives it really nice regulated constant cash flow that makes it able to sustain this larger dividend payout ratio over the long term, as again, historically, it has been in that 65 to 75% range. So this is really nothing to worry about. Looking at the 6-month stock chart, you can see that TC Energy Corp has been performing very well, just like all the other energy companies out there. But what I really like to see is that over the 5-year, we can see that it still hasn't really recovered fully from the effects of the pandemic. In January 1st of 2020, it was trading around $73. It then dropped all the way down to around $50 a share, and it's slowly been recovering since and is around that $61 range today. And looking at that max chart, you can really again see the reliableness and steadiness in TC Energy Corp over time and how it's a great one to hold long term. TC Energy Corp has one of North America's largest natural gas pipelines. Its network expands across North America and really is a well-established and well-run company. It is also another great dividend growth company, having raised its dividend for over 20 years straight. And over the past 20 years, it's raised its dividend at an average rate of 7% annually and is planning and poised to continue this up into the future. To recap, TC Energy Corp is a natural gas company that has pipelines that span across North America, with the majority of its business being in long-term contracts, which makes it a really reliable and steady dividend payer. Not to mention, it's been growing its dividend at 7% every single year for the past 20 years, and over the same time period, it has given its shareholders an average annual return of around 12%. TC Energy Corp currently has 7 analyst price predictions, 4 being buys and 3 being holds, with the average price prediction for the 12-month forecast being at $68.71, a 12.54% upside, with the high end being at $73, closer to that 25% upside. So we've now covered two great dividend stocks to buy for the month of May. We saw one that had a pretty small dividend yield, the second with a little bit higher, and the third stock that I'm going to cover is right in the middle between the two, around a 4% dividend yield. In the current state of the stock market, we're seeing all-time highs and we're really seeing record average price to earnings ratios across the board. However, this company that I'm about to feature in stock number 3 currently has a PE ratio below 10. The stock and company is in the financial sector, and it's currently a stock that I'm building up a position in my own personal portfolio. The company is Manulife Financial, ticker symbol MFC. Manulife Financial currently trades at $26.79 per share, and it currently has a market cap of around $50 billion. So all of these companies I've been featuring today are very well established and large companies. And as I mentioned, the main reason I like Manulife Financial is its PE ratio is currently under 10, sitting at 9.14. This PE ratio signifies that Manulife's share price is not really out of whack in relation to its earnings, as we are seeing with other stocks out there in the stock market currently. And Manulife currently has a dividend yield at 4.15%, so a really solid dividend. Manulife currently has a dividend payout ratio sitting around 34%, which again is super reliable and super sustainable long term. This is right in the wheelhouse where historically Manulife has tried to keep their dividend payout ratio, which is just another good sign moving forward. And one thing to know with Manulife is that it actually has its earnings coming out today, so you definitely want to make sure you stay tuned and look at those. Looking at the stock chart for Manulife, we can see that over the past 6 months, it has gone on an absolute tear, as has the rest of the financial sector. Both the Canadian banks and these large insurance companies have been doing extremely well over the past 6 months. And if we go to the max chart for Manulife, we can actually see that compared to the 2008 price, right before the housing market crash, which absolutely devastated insurance companies such as Manulife, there's still a lot of room to grow to get back to those all-time highs. And I think Manulife can really get there back into that $40 range in the future. What Manulife has going for them right now that will lead to that extra revenue and profit in order to get to that $40 per share range is the fact that it's really growing its footprint currently in the Asian markets and aggressively going after the Asian markets, which I think is a great opportunity for Manulife Financial. They're really starting to see some growth in that area, which I think is just going to grow the business over the next few years and be a really main driving factor for Manulife. Manulife currently has 8 analyst ratings, 4 being buys and 4 being holds, with the average analyst price prediction being at $28.68, a 7% upside from the current price. However, the high estimate, which excites me, is at the $33 range, which would be a 25% upside from current share price. So this is not only a great dividend stock, but also has room to grow in share price over the coming year. So there you have it, 3 great dividend stocks for the month of May. I truly think there's a dividend stock within this bunch for every different style of investor. You've got some on the higher dividend yields, some on the lower end, and some great dividend growth stocks for any investor. I truly believe these are great buys for the month of May. I truly hope you guys enjoyed this video and found it informative. If you did, make sure to hit that like button and subscribe to the channel. Lots more crazy content coming over the next few weeks. So again, I hope you guys enjoyed, and I'll see you in the next one.